China has finally snapped. With the pandemic now a thing of the past, the structural problems ailing China's economy have become too much for its government to ignore, and now they've decided to throw the kitchen sink at them. Now, if you're holding crypto, you absolutely need to know what they've been doing, because, believe it or not, China's new economic policy has the potential to pump your bags like crazy. To find out why, you've got to watch this video until the end. Stay tuned. Now, China's economy has no shortage of problems. There's a persistent downturn in the property market, weak domestic demand, youth unemployment, and trade frictions with the West, to name but a few. If you're not up to speed on the details, then I recommend pausing this video and watching the last one we made on this topic, linked to over here. We posted that video about a year ago, and since then, the fundamental picture has remained similar. Exports are doing well, but aside from the recent rally, asset prices continue to fall, dragging consumer confidence down with them. With precautionary savings weighing down on domestic consumption, the threat of deflation is stalking China. Max pain would be China suffering its own lost decades, a la Japan. After Japan's property bubble burst in 1989, the ensuing deflation took 30 years to shake off. So the notion that China could suffer a similar fate might be behind some of the clickbait floating around about China's economy collapsing, imploding, or otherwise failing in some dramatic fashion. However, this is largely just cope from people living in countries whose economies are growing much slower than China's, if not actually shrinking. In Q1 of this year, China's GDP grew 5.3%, and in Q2 it was 4.7%, which was below expectations. This prompted the latest round of China doomsaying. But since China is the world's second largest economy, let's compare this with some of its peers. In the US, GDP grew by 2.9% in Q1 and 2.3% in Q2. In the UK, it was 0.3% in Q1 and 0.7% in Q2. In Germany, GDP fell by 0.1% in Q1 before making it back up to 0% growth in Q2. And then there's Japan, where GDP fell by 0.9% in Q1 and a further 1% in Q2. It's funny how you don't hear about the coming collapse of any of these guys, but hey, let's not kick them while they're down. Anyway, by its own lofty standards, China's economy printed some pretty lackluster numbers recently. That 4.7% growth in Q2 was significantly below the government's 5.1% target for the quarter. This prompted Goldman Sachs and Citigroup to lower their full-year projections for China's GDP growth to 4.7%, down from 4.9% and 4.8% respectively. With fewer than 3 months of the year left, the heat is now on the Chinese government to meet its full-year target of 5% growth. As we'll soon find out, what needs to be done to meet this immediate target and what needs to be done to address the root causes of China's economic challenges may be slightly different. But let's go one step at a time. Alarm! We regret to announce that the Bro Crypto podcast is sponsored by the Coin Bureau Deals page. This is the place where you can find the very best deals and promos in the crypto space. From trading fee discounts of up to 60% to sign-up bonuses of up to $100,000 on some of the best crypto exchanges. You'll also find crazy discounts on hardware wallets, and you can sign up for our exclusive Coin Bureau Club there too. So, check out the Coin Bureau Deals page today. Otherwise, you'll have to keep listening to these two idiots.
Hell, that's the problem a lot of crypto bros have these days. They're inside too much, 24/7 on the
computer. Open your inside, you need to get out, you need to get some sun, you need to get some vitamin D.
In the last week of September, the Chinese government and central bank announced a surprise stimulus package in an attempt to re-energize the economy and shore up investor confidence. China's executive, the Politburo, pledged that it would, quote, strive to achieve the annual goal and take action to make the beleaguered property sector, quote, stop declining. The People's Bank of China duly responded by promising to, quote, act immediately and go all out. And so it did. The central bank rolled out a series of measures to inject liquidity into the economy. It cut the amount of cash banks have to hold as reserves, slashed borrowing costs, and lowered the interest rate on its one-year loans to lenders by the most on record. The cut in the bank reserve requirement rate in particular has freed up about 1 trillion yuan, or $140 billion in long-term liquidity. This will enable banks to lend more and buy government bonds issued to fund infrastructure spending. In addition, China introduced a support package for the struggling property market, which has been the source of the worst publicity for China's economy over the last few years. This package includes a 0.5% reduction on average interest rates for existing mortgages and a cut in the minimum down payment on all types of homes from 25% to 15%. The government also issued stimulus payments and floated new subsidies for some unemployed graduates. The jobless rate for people aged 16 to 24 and not in education rose to 18.8% in August, its highest level since the introduction of a new record-keeping process last December. This is more than triple the overall unemployment rate of 5.4% in August, suggesting companies are hesitant to hire new employees amid an uncertain economic outlook. And for the first time ever, the central bank also announced a direct injection of liquidity into the stock market to the tune of 800 billion yuan, or roughly $110 billion. This comes through stock repurchase financing and operations such as swap facilities between securities, fund and insurance firms. Now, this is a significant departure from previous policy, as the bank used to restrict capital flowing into the stock market and is now requiring that this injection of liquidity is used exclusively for stock purchases. This change came in lockstep with a change in the language used by the Politburo. The Politburo's September communiqué was less than half its typical length, and the standard assessment of the economy as, quote, stable with positive momentum but facing many challenges, was conspicuously absent this time. Instead of calling for the typical, quote, prudence and precision, monetary policy now focuses on, quote, reducing reserve requirement ratios and implementing decisive interest rate cuts. For the first time since the pandemic, the government sounded urgent when discussing the state of the economy. Now, they didn't mention anything about urgently pumping the bags of billionaires, but that is precisely what they did. In the week of China's stimulus rollout, the wealth of the 54 Chinese nationals on Bloomberg's Billionaires Index increased by $130 billion, or about 19%. It was the biggest week-long gain for China's billionaires on record. Now, financial stimulus tends to be bullish for asset prices and risk assets like equities in particular. As such, the people who control the largest share of them benefit the most. And this time was no different. In the last week of September, China's stock market went on an absolute tear, posting its biggest single-day gain since 2008 and making the country's richest a whole lot richer. And if you listen very hard, you can just about hear Karl Marx spinning in his grave. Anyway, aside from being a boon for China's billionaires, this marked a sharp reversal of fortune for Chinese equities, which have been underperforming global markets for years. Retail investor FOMO apparently became so intense that Shanghai's stock trading systems were overwhelmed, causing delays in order processing. In the 5 days after Beijing began rolling out its stimulus measures, China's CSI 300 blue chip index gained 25%, its strongest 5-day performance on record. Meanwhile, the broader Shanghai Composite Index rose 21.4%, its strongest 5-day performance since 1996. An editorial in the official China Securities Journal argued that, quote, revitalizing the market is a key breakthrough to lift confidence and improve economic expectations, citing, quote, market sluggishness, which in turn sapped investor confidence in a negative loop. However, much of the commentary that followed China's stimulus blitz focused on the need to do more to address the deflationary pressures ailing the economy, namely weak domestic consumption and high levels of precautionary saving. The monetary stimulus was well received, but it did little to address these problems and was dismissed by Financial Times and Reuters pundits as cosmetic and a mere sugar rush. For an example of what they mean by this, making borrowing cheaper is a good start, but amid falling prices, credit demand has become so weak that households and corporations may still not want to borrow. Similarly, the property market is down so bad that housing is no longer seen as the safe investment that it once was. Lowering mortgage rates and down payment requirements is unlikely to reverse this perception. On the other hand, lowering existing mortgage rates will increase household disposable income, which should boost consumption to some extent. But there is some ambiguity in the relationship between asset prices in the property market and consumption. Some say that a long-term shift away from real estate as the preferred investment vehicle will free up expendable income for consumption that would otherwise have been saved up for an apartment down payment, for instance. However, in the near term, the property slump means fewer jobs, lower income growth, and uncertainty about the future, all of which are bad for consumption. And on the whole, the positive effects of the stimulus may be offset by contractionary government spending, which is lower than it was last year and has fallen significantly short of the budgeted level. This is largely because of declining government revenue and the lack of capital investment projects available for funding by government special bonds. This fiscal contraction is exacerbating China's deflationary pressures. And that is why all eyes are now on China's Ministry of Finance to follow the monetary stimulus package with an equivalent shot in the arm from fiscal policy. This was the consensus view of a recent forum of chief economists at the People's Bank of China School of Finance. At the forum, leading economists agreed that the central bank can't carry the team without a change in fiscal policy from the Ministry of Finance. As former central bank advisor Yu Yongding put it, quote, "The stock market has gone up, but if the Ministry of Finance cannot step up, the effectiveness of the central bank's policies might begin to diminish. The central bank has already done so much in terms of monetary policy for industrial financing. How much more can it do?" Yu says that to meet its 5% growth target, China should begin by increasing infrastructure investment. He argues that measures to boost consumption alone would not be sufficient to prop up growth amid declining income growth and falling asset values. Yu's thinking is probably informed by the outlook from the property market, which has yet to find a bottom. Most leading indicators, like land sales, are down around 70% from their peak 3 years ago. But lagging indicators, like total floor space under construction and construction activity, are only down by around 20%, suggesting there is quite a lot of downside left. At the forum, Yu made reference to hearing, quote, rumours of a forthcoming change in fiscal policy, but emphasised that he didn't know the position of the Ministry of Finance. Now, this was likely a reference to a story published by Reuters that suggests that the ministry is planning to issue 2 trillion yuan, or $284 billion worth, of sovereign bonds this year. According to that Reuters article, this funding would be split between stimulating consumption and debt relief for local governments. Notably, nothing about infrastructure spending in there, and perhaps that's why Yu made a point of mentioning it. Now, if this 2 trillion yuan is indeed in the pipeline, not much of it will be spent this year. The nearest opportunity for a mid-year budget adjustment would be the National People's Congress Standing Committee meeting in late October. There would likely be a lag between announcement and issuance, so the funds might not be made available until December. If so, then any follow-up to the stimulus from the Ministry of Finance likely would not have any direct effect until next year. Nevertheless, a mere announcement would be welcomed and would likely have an important indirect effect on consumer and business confidence going into 2025, when we might be able to expect a real improvement in consumption and investment. Now, observers inside and outside of China seem to agree that fiscal policy is the ticket to addressing the structural challenges facing China's economy. The recent stimulus rollout was welcomed, although with mixed levels of enthusiasm. Some called it a bazooka, some called it a sugar rush. Whichever metaphor you prefer, the shock analogy seems appropriate, but China's economy needs more than that if it's to be re-energized. Crypto, on the other hand, is an entirely different story. If it's big green candles you're after, then stimulus is exactly what you need. The good news is this is likely just the beginning. According to Ting Lu, the chief China economist at global investment bank Nomura, quote, "The consensus is that there is no need to debate anymore. Easing and stimulus should be increased." Or, in crypto speak, he's saying money printer is about to go brrr. Now, do you remember how much Chinese stocks pumped after this first round of stimulus? The CSI 300 rallied 25% and the Shanghai Composite Index 21% in just 5 days. The combined market cap of the companies in these indices is more than $11 trillion. That's around 5 times the size of the total crypto market cap. The only question is just how much of this monetary easing and stimulus will find its way into crypto. Now, you may have heard that crypto is banned in China, but this is a misconception. China is Binance's biggest market, after all. According to the Wall Street Journal, Binance had 900,000 active users in China last year, who were responsible for up to $90 billion of monthly trading volume. And according to a survey by the Vietnamese crypto VC Kairos Ventures, 90% of crypto users in China are centralized exchange users. Clearly, if you want to buy and sell cryptos, you are able to do so. And as far as we can tell, you're not likely to face any negative consequences. The Chinese government's main concern regarding crypto is capital flight, not degens flipping meme coins on Binance. However, if you're a millionaire or a business of significant size trying to circumvent controls on capital movement, then forget what I just said because it does not apply to you. If you're trying to move large sums of money out of China via crypto, then the federales will probably want to have a word with you. So, Chinese investors can buy crypto, but will they? Hopefully, the Hong Kong spot Bitcoin ETF flows are not a useful indicator here because the latest data we have suggests that nobody is buying these. Admittedly, we only have data up to the 26th of September, 2 days into the stimulus rollout, but on that day we saw net outflows of $1 million. This is basically nothing, so let's move on. The stimulus announcements and Politburo meeting took place over 3 days from the 24th to the 27th of September. In this period, BTC rallied 6%, including a pretty respectable 5% daily candle on the 26th, the day of the Politburo meeting. For what it's worth, this was a bigger daily candle than the one we saw on the day of the Fed's rate cut on the 18th of September. Now, we can't say for sure that it was China pumping BTC in this period, but the news of the stimulus clearly didn't hurt. However, we should note that a significant portion of China's crypto trading actually takes place away from the public market and does not directly impact the charts that you or I are looking at. This is because the use of P2P networks and OTC platforms for buying and selling crypto in China has grown tremendously over the last few years. According to Chainalysis, it has roughly tripled since 2021. Now, this growth can be attributed to restrictions on accessing mainstream crypto exchanges, which, albeit not inaccessible, presumably now need a VPN. P2P and OTC trading are more freely accessible and not subject to the same access restrictions. OTC and P2P trades are private and do not move the price of BTC in the same way that buying and selling on exchanges does. Of course, OTC and P2P sellers need to acquire BTC in the first place, and they will have to buy on the open market, which will push BTC higher. And then again, if China is Binance's biggest market, there should be more than enough public market buying from China for us to all see more beautiful big green candles in the not too distant future. The charts might not be going bananas just yet, but they will, and perhaps sooner rather than later. Until then, if we can get a 5% daily candle every time China's central bank switches the money printer on, well, we'll gladly take it. To date, China has not been one for quantitative easing. Stimulus measures were previously likened to drinking poisonous liquor to quench one's thirst. But China's government and top economists have made it clear that this view is now out and monetary easing is in. If China is really about to chug QE Kool-Aid at anything like the rate Western countries have since 2008, then we're probably not bullish enough. Remember, fiat currency debasement by money printing is how crypto wins. The more they print, the more money will flow into Bitcoin, and the more money flows into Bitcoin, the more money flows into altcoins. You know how this works, right? If your bags are packed, all that's left to do is DCA into some popcorn, kick back, and enjoy the show. And we'll leave it there, folks. Don't forget to drop your hottest take about China's economy in the comments. And if you got something out of this video, then go ahead and stimulate those like, subscribe, and bell notification buttons too, so you can catch our next video before anyone else. As always, thank you for watching, and I'll see you next time. This is Guy, signing off.